As of yesterday, it was below 5 trillion, but it's still below 5 trillion, 4.89. But as of Monday, it was 5.2 or something like that. I mean, in 1 year, and it was a relatively volatile year with all the political uncertainties and stuff. This company essentially made its investors uh, almost 60+%. Why? There was a lot of risk. I mean, people took that risk and they got rewarded for it. On the other hand, same thing didn't happen for Coke. And let's see what happened to Coke over the last year. Come on. And this was a relatively down year, economy wise. What's going on with this thing? I don't have internet. Let's see. Okay, I have it now. Come on. Okay, let's get the charts for 1 year. Uh, it's actually even down. No, I don't think this is 1 year. Oh, not much happened to Coke, which is normal because not much happened to the overall economy. So, but since you didn't take that much risk, you're not, as a Coke investor, you're not complaining that Coke didn't do that much. So, if that's the case, if investors rank assets based on reward per unit of risk, equilibrium suggests that for any two portfolios, P and Q, we have to have the following equation. Basically, if you tell me any two portfolios, these could be individual stocks. Remember, an individual stock is a trivial portfolio consisting of only one stock. If this equation is not satisfied, then market forces will move so that it becomes satisfied. Let's say, for a lot of different reasons, NVIDIA has a better reward to risk ratio compared to Coke. If I know this ahead of time, I'm somebody guarantees me that that's going to be the case. I'm going to go ahead and buy NVIDIA and short Coke, right? Well, I'm not the only smart person in the market. A lot of people will do it. As a lot of people will do it, the price of NVIDIA is going to go up and price of Coke is going to go down. Since the future of the companies are the same, if the price of something goes up, the return that I expect from that goes down. So extra demand for NVIDIA will decrease expected reward or the excess return for NVIDIA, and excess supply of or sales of Coke is going to reduce the price of Coke, which means it's going to increase the reward. So this will happen until uh, this is true. Well, then the next insight is that market portfolio is also another portfolio. Hence, we must have in equilibrium the same restriction. For any portfolio P, reward to risk ratio of any portfolio should equal to the reward to risk ratio of the market portfolio as well. If we normalize uh, to be 1, remember we define beta as the degree to which a portfolio is sensitive to systematic risk. We didn't say anything about magnitude. So all we care is the relative sensitivities. Well, if that's the case, I'm going to call price of something 1 or value of something 1, and everything is expressed in terms of those. It's the same idea with prices. In the old days, before money was invented, prices in the market were relative prices. If you give me 5 sheep, I gave you 20 bushels of wheat, right? So the relative price of sheep was 1 sheep is equal to 4 bushels of wheat. But now we have something called money. What's the price of $1? Oh, it's $1. So it's kind of what we call a numeraire or the reference price. Same idea with the beta of the market portfolio. It is 1. Well, if that is the case, then we must have or rearranging this. Let me just copy this. Okay, that was the equation that I wrote. But I didn't write it simply thinking, that must be the case. It came out of a principle. So it basically says reward for any portfolio is proportional to the reward for the market portfolio, and that proportionality constant is the beta. So the higher is sensitivity to systematic risk, which is beta, the higher is the reward that you should expect from the market, from the portfolio. If we solve this for expected return of portfolio, we get and this equation is called security market line, or SML. And this method of pricing assets is called the capital asset pricing model, or CAPM. This is a relatively simplistic model. In this model, there aren't any multi-periods. There is now and there is future. Okay. When we say expected return, we're not necessarily talking about 1 year returns, some type of future returns.